show that we had a great lineup today, and our next presenter is a professional trader, registered investment advisor, and commodity trading advisor. He's an active trader of his own account, and he also manages option-oriented accounts. He speaks on option strategies at many seminars in the US, Canada, and Europe. Prior to founding his own firm, he was a proprietary trader at two major brokerage firms, primarily Thomas McKinnon Securities, where he ran the equity arbitrage department for 9 years. He's perhaps the best known as the author of Options as a Strategic Investment, the best-selling work on stock and index option strategies, which has sold over 300,000 copies. He's regularly quoted in publications such as the Wall Street Journal, Barron's, Technical Analysis of Stocks and Commodities, Data Broadcasting Exchange Magazine, Futures Magazine, TheStreet.com, and Active Trader Magazine. Ladies and gentlemen, here to present what our current option indicators are saying about the market, it is always my honor to introduce Mr. Lawrence McMillan of McMillan Analysis Corporation. Welcome back to Traders Corner, Larry.
Thanks, Rob. Yeah, pretty interesting market these days, so hopefully we'll be able to wander through these indicators and come to some conclusions.
How about this morning? Oh my God, I can't get over it.
Yeah, pretty crazy. Well, we're so oversold that stuff like that can happen. Probably doesn't stick around that long, but at least it can happen. But one of these days we'll get a tradable decent rally. Anyway, just a little background on our company. I started this as a derivatives research firm about a little more than 30 years ago, actually, and we were doing newsletters, data analysis, that sort of thing. But after some pretty successful recommendations during the financial crisis of 2008, we moved into money management, both in the futures and on the stock side. And then we also have an education arm, webinars like this, mentoring, etc. I'm just going to show you this right now, just to say if you go to this web page, you will be able to download a PDF of this webinar, and we're also recording it. We'll come back to the other stuff later. So the main things that I look at as far as the market are concerned are these four things. The first, of course, is the chart of the S&P 500. That's the most important thing. That is the market, so your indicators need to be in tune with price, or you've got to have a problem. Then we're going to take a look at a very useful option indicator, the equity only put call ratios. Then we look at market breadth, which we also have an option twist to that, and then some various things having to do with the volatility index VIX. So the number one thing I want you to remember, if you don't remember anything else about this webinar, is that oversold does not mean buy. So we've been oversold off and on really since probably late January of this year, but there have only been a few real true buy signals, and so obviously oversold markets can continue to fall for quite some time. I know it makes for good headlines to say you picked the bottom, but how many times do you try to pick the bottom and didn't really get it? There's a companion saying, and that's that overbought does not mean sell, but we don't have any overbought indicators right now. We did back in August, believe it or not, but we don't right now. So here's the long-term 2-year chart of S&P, and the big thing on this chart is these blue lines here. These are the trend lines defining this bear market. So you're having a series of lower highs and lower lows, and that defines a bear market. You don't need 20%, 18%, whatever for those percentages. They're all just sort of meaningless. But we are in a downtrending bear market. Now you can see back in on the lower left here, back in 2020, we declined 35%, but we rallied, back from that pretty quickly. Then after that, the next correction of any meaningful size was only a 10% correction in September of that year, and then the next year, the biggest correction was 6%. So, very steady upward market. But now things have changed, and we're in a severe downtrend. The this morning, I believe, actually made the lows for this move at 27.4%, down from the top on early January. So yeah, we're having a big rally off that bottom. We'll see if it holds. We had a couple of big rallies, rally days 2 weeks ago, and they ended right here, and then we dropped a lot after that, and that's happened many other times too this year. We'll take a look at this, but bear markets are typically spotted all over the place with oversold rallies that don't hold, and so far that's what's been happening here. Here's the 1-year chart, and the green numbers there, those are the size of the oversold rallies that have happened so far this year in terms of S&P points. And of course, those are tradable. I mean, those are big numbers, a lot of them. You can see we had a 380-point rally there, a 500-point rally there, a 550-point rally off the June lows. But now we've run into trouble. That rally ran into trouble right at the trend line and also right at the 200-day moving average of S&P in mid-August, and it's been pretty much free fall ever since. Those 3 circles on the chart are all what we call island reversals. The market gaps up into a trading range, which can be a couple of days or even a couple of weeks, and then get back down out of it, leaving an island on the chart. They're very rare in terms of a broad-based index like the S&P, and to see 3 of them in close proximity like this is pretty negative, but they're there. And if we start to close those up, then that would be bullish. So the first thing you really want to see is, can the market trade up here to about 37.40 and close that first gap? That might be an indication that, okay, this rally, whatever rally that is, has a little bit more legs than just any old rally. I'm going to back up to the other chart just for a second. You notice that if we were actually come down now, let's say, and touch this bottom trend line again, we'd be down around 3,000. So there are people who do these 5 count things. I'm not one of those, but that are, kind of predicting that that's what might happen off of that chart. I'm much more in line, trying to stay in line with our various indicators, which I'm going to show you. So just to summarize that, the S&P chart has been bearish really since January. Certainly once it fell below the December lows of the previous year. That's sort of an old trading system that if you fall below the previous year's December lows, then you're going to have some trouble. We've certainly had some trouble. The support at 3,500, which we touched last week, and now we touched again this morning. I think the low day was 34.91. But overhead, there is that resistance at that first gap I showed you at 3,700 to 3,750. So typically, oversold rallies will rally right back up to about the declining 20-day moving average. Sometimes you overshoot it by a little bit, but right now that 20-day moving average is at 3,700. So all these things kind of line up to say that that 3,700, 3,750 area is quite important. And, you probably should be exercising some caution as you approach that. If it goes on through, then of course you can get more aggressive on the long side. So our basic attitude, and has been for quite a while, really since January, is to maintain a core bearish position and trade other signals around it as they occur. And that doesn't necessarily mean only buy signals. You can also have sell signals. I'll show you how one of those came about later. Anyway, another thing we do with the S&P chart is we draw modified Bollinger Bands on the chart. So when John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices. And that seems to me to be a pretty good definition, but that's not what the math guys use. Black-Scholes, for example, and others began to use, or not began, but did use, and still do use, the standard deviation of daily percentage price changes. So it gives you a slightly different number, but since we're in the option business and our implied and historical volatilities need to agree with Black-Scholes, otherwise a lot of our modeling and comparison software wouldn't make any sense. we're going this way. So we draw a plus or minus 4 standard deviation bands. If the market moves outside those bands and it comes back in, that's a signal. So this is the last year with the Bollinger Bands, modified Bollinger Bands drawn on the chart, as well as the signals themselves. So this top line right there, that's plus 4 standard deviations. The line just inside is plus 3 standard deviations. So you can see right here, we moved outside of 4 standard, inside of 3. That was a sell signal. Our sell signal looks to touch the bottom band. So it did touch it right over here. So that was a fairly short-lived but successful sell signal. Then we got a buy signal down here. It took a while, but eventually did go up there and touch the upper band. We had a stronger buy signal down here, which again, as I pointed out in August, touched the upper band. And now we had a failed sell signal, buy signal here. Not every signal is a winner, and that one wasn't. You see, we came below the 4 sigma, went inside, and then came back outside again. So that's your stop out. But now we're in a new buy signal from this indicator. In fact, this is our only confirmed buy signal right now, pending maybe some things that might come in later today. But at the current time, that's our only confirmed buy signal. And so we're looking for the market to go up and touch this upper band, which is, you see, dropping rapidly. So the longer it takes for that to happen, the more that's going to drop. And the stop out is down here at the lower band. So that last buy signal was confirmed on October 4th, and we're looking for it to eventually rise up to the upper band. So we do these modified, we call them McMillan volatility bands signals on a number of charts, and we can do all futures, all stocks, all indices. If you're interested in that, we have a fairly low cost service that will notify you of any entity that's getting a MVB buy or sell signal. So let's move on to the next topic, put call ratios. So put call ratios are contrary indicators, and we use the equity only put call ratio, that's all stock options that trade, to predict the broad market. Marty Zweig invented this theory of trading back in the 1950s, and by contrary, I just mean if there's too much put buying, then everybody's looking for the market to go down, and therefore we want to look for it to go up. Conversely, if there's too much call buying, everybody's looking for the market to go up. We want to look for it to go down. So we have ways to quantify these things. The standard put call ratio is just, at the end of the day, we sum up the volume of the puts that traded on each entity, say IBM, for example, sum those up separately, sum up the calls, divide the two, that's the put call ratio. So this is what we publish over 1,600 put call ratio charts on our website every day, and it's a low cost subscription area to look at those. And we also have a computer analysis that tells you where new buy and sell signals are coming in. But typically, a put call ratio chart, when overlaid with the stock chart, should look like this. They should be the inverse of each other. So basically, let's just quickly look here. If the stock is declining, people are buying puts, forcing the put call ratio to go higher. Eventually, the put call ratio makes a local maximum, and a local maximum on your put call ratio chart is a buy signal for the stock. So then let's say the stock starts to rise higher. As it's going up, people are buying calls. When you buy calls, that forces the put call ratio lower. Eventually it gets to a local minimum on the put call ratio chart, and that's a sell signal for the stock. So here's not the current chart, but this is the equity only put call ratio on the bottom, and the S&P 500 on the top, and you can see the inverse symmetry that exists most of the time. That's why we use the equity only put call ratio to predict the broad market. So here's where we stand right now today. So we had a series of local maximum minimum. Let's just get over here. So we had a local minimum there. That was a sell signal late August. Market rose up at about a week and a half ago. It looked like it was going to peak out and give us a buy signal, but now it's moved up to new highs. In fact, this is the highest we've been since April 2020. And so we're back on a sell signal because the ratio is rising, and we're waiting for it to come up here and attempt to make another local maximum, which would be a buy signal somewhere down the road. We have computer analysis programs that help us analyze these things, sort of like a chess tree playing software, that kind of a thing. Now, as computers came along, we were able to calculate a more sophisticated put-call ratio, and that's the dollar-weighted put-call ratio, where we look at the dollar spent on puts versus the dollar spent on calls. And so this gives you signals pretty much the same timing, but they're more extreme on the chart. So here's the current chart. Again, there was this local minimum here, and that's this ratio, which is a sell signal. Little wiggle here, looked like a buy signal, but then the ratio went higher, and now it's really racing higher. And so we're going to need to see that thing roll over and begin to decline before we actually have a buy signal from that chart. Again, this is the highest it's been since 2020. It's interesting to note that last November, the ratio was the lowest it had been in 18 years. So we went from extreme optimism to extreme pessimism, well, let's even say here, in a matter of 6 months. So that's how, consumer sentiment, or whatever you want to call it, can quickly change, and has quickly changed. So here we've got these sell signals in place. They're obviously very high in their charts, meaning there's a lot of put buying has been going on. So they're oversold. But again, oversold does not mean buy. So we'll see if these things roll over. We're not looking to catch the exact bottom on any of these indicators, but when they do change in trend, we hope that we're catching a strong trend after they turn. Now, what do we buy when we're actually buying one of these things? Typically, we buy SPY calls or puts, calls for buy signals, of course, buy signals on the market. And basically, I like to buy SPY calls that have a fairly high delta, or if I'm trading any other stock or option on a stock, I think the stock is going up, let's say, I want to buy a call with a fairly high delta. I don't want to buy a call that's way out of the money and doesn't respond, even if the stock goes up. So it does me no good if I'm right on the stock, but wrong on the option. So we buy an in-the-money option typically on SPY, 1 or 2 strikes in the money. Those will typically have a delta of 0.7. Sometimes we buy an at-the-money option. It still has a delta of larger than 0.5. So that means 0.7 means if the stock goes up 1 point, the call will go up 70 cents. So if you watch TV, the option guys, they're always spread, and that's sort of silly. I mean, no real option trader spreads all the time. You spread at a specific time when the options are expensive. But when you spread, what you do is you buy a call at this strike, and then you sell a call at a higher strike. So that, saves you a little money in terms of this call you sold, but you cut off your profit potential right here. So if we look at, say, what a call option purchase would look like, the red line, it has unlimited profits to the upside, whereas the spread has profits that are cut off. Now, proponents of the spread will say, well, you're not risking as much. You are risking exactly 100% of what your broker requires you to put up to establish the spread. It just says you're risking 100% if you buy a call. So that's a fallacious argument. What you really want to say is, if you're talking about dollars, then buy a few less calls than you would have bought spreads, and you're in the game with no cutoff to the upside. Now, when options are expensive, it does make sense to do spreads, and right now VIX is pretty high, so when we're trading these SPY positions, we're trading spreads. But you can mitigate the negative aspects of the spread by spreading the strikes out as far as possible. So right now, when we're buying SPY call spreads, we're distancing the 2 strikes 15 to 20 points apart. And if we're buying SPY put spreads, we're distancing the strikes 30 to 50 points apart, because SPY puts are more expensive on a relative basis than SPY calls are. And then you can also, if the stock rises up to your short strike when you got the bull spread on, you can roll your spread. What do I mean by that? Well, let's say you start out here with SPY at 397. You buy at 397 call, you sell at 415 call, 15 points difference in the strikes. Then later, the stock goes up to 412. So you take your profits on this spread, so you sell that spread for a profit, and now you buy a new 15-point spread. You buy the 412 call and sell the 427 call, etc. So, and on the downside, you do the same thing if you're in a put spread and it hits your short strike. So whenever your short strike is hit, you're in danger of not really making much more from this position. And if the market is trending, I think you should adjust. And this is how you adjust. So just a couple of individual put call ratio charts. This is Bristol Myers. You can see on these stocks and futures individually, we want to put the local maximums to occur at a very extreme level, the local minimums, extreme levels. So this was a great buy signal here. This one wasn't too hot. And this one, we've put a contingency on here. We want to see the stock break out over 72, which is this red line here, before we're actually going to act on this signal, and it hasn't been able to do that yet. Here's another one just popped up last night, PPL Corp. You can see that the last time the put call ratio was up around this level, there was a decent buy signal here, a little, but pretty good. And now we're at that same level again. However, the stock is falling badly, so I'd want to see some improvement in that chart. Maybe break a trend line or something before I just jumped in there and tried to catch a falling knife, which I don't do. And then we can also trade equity futures. The bottom line here is the put call ratio chart of corn options, the corn futures options that are traded on CB Chicago Board of Trade. But the chart on top is a continuous chart of corn futures. But you don't necessarily have to trade corn options to do this. There is an ETF, CORN, which tracks the price of corn. So sometimes you can use the corn options put call ratio to generate a buy signal. And then if you don't have a futures account, you can still trade in that entity by using the ETF that trades on the stock side of the fence. All right, so the next thing we look at is market breadth. I really didn't look at exactly what time we started here, but in any case, there's two things we can do with market breadth. First, we can just keep a cumulative running total of breadth. And then second, we can calculate oscillators. So we're pretty big on the oscillators. Our definition of an oscillator value is today's oscillator value is 90% of yesterday's oscillator value plus 10% of the difference between today's advances minus declines. So everyone knows that the New York Stock Exchange reports advances and declines in all kinds of media every day. But the New York Stock Exchange has a bunch of things that aren't stocks, and you can get some distortion there. So we also have what we call a stocks only advanced decline. And for our purposes, what goes into this is all stocks that have listed options on them. There's over 6,000 of those now. So it's a pretty big data set. And this is our oscillator going back to 2013, quite a while ago. So if the oscillator falls below minus 400, it's oversold. And if it rises above plus 200, it's overbought. So for, most of the time from 2013 all the way up to, well, really this year, the market didn't get oversold very often. Yes, we had a big oversold condition right before Christmas in December of 2018. Then March 2020 was equally oversold. What's sort of interesting to note is that recently we actually became the most oversold in history, exceeding those two levels. And you can see how much more green area there is here recently, all these oversold conditions. Well, right now, we're about right here. So we're really very oversold. We need to see it pop up out of here to give us a buy signal. So we got a sell signal back there in September. Technically, that is still in effect, although we've rolled many of our positions since that was established. But if this oscillator can work its way back up to here, we would go long. That doesn't necessarily mean we give up on our core bearish position, but this would be one of the things that we trade around that core bearish position. So these typically are pretty short-term signals. They kind of have some whipsaw losses, but they can also have some great gains. So as I said, we're on those sell signals from September 13th, and as we buy spreads and they hit their lower strike on the put, we roll them down. So you know, we're even if the market were to rally back up here strongly, we still have a profit locked in. Cumulative breadth, I mentioned you can keep a running total of breadth. This isn't saying anything right now. It's really only useful for spotting tops, but it made a new high in June 11th of 2021. And then cumulative breadth did not make a new high after that. As you know, S&P kept on making new highs all the way up through January of 2022. And that was a big divergence right there, which was a big warning of trouble ahead. And, you know, we're in trouble. So it was very good. And right now, of course, it's not meaningful, but it's something to keep an eye on the next time that S&P is making new highs. And, you know, it will again someday. So we also look at new highs versus new lows. This gave a sell signal for us back in April and has not gotten off that sell signal since then. So yesterday, new highs on the New York Stock Exchange, I believe there were 8. I mean, you know, that's a pathetic number. So, you know, back then in January, February, March, it was somewhat interesting to note that a lot of stocks are making new lows, even though S&P was just coming off its highs. But now, you know, maybe not as many stocks are making new lows, but to me, that's not the important thing. You need to see some new highs start to be made before this indicator will actually reverse. And that's 52-week highs, not all-time highs. So let's finish up by looking at VIX and the various VIX indicators. So VIX is a CBOE's volatility index. There's 2 things about it that are really important. Number one is the trend of VIX. It trends opposite to the market. And number 2, it spikes up when there's trouble and spikes back down again, often giving you some interesting buy signals. So low VIX is overbought. We haven't seen low VIX in a couple of years, so don't worry about that. So here's the current chart of VIX, and let's first talk about the trend. So this is a trend sell signal right here because the 20-day crossed above the 200-day, and VIX is also above. And now we just had that happen again mid-September. 20-day crossed above the 200-day and VIX is above. So as long as both of these are above the 200-day, which is right here, this intermediate term sell signal is in effect. And it was pretty well timed right there. And it's doing, you know, as this intermediate term sell signal goes, is doing quite well. The bigger picture, you might look at this chart, you're wondering why is VIX not up in the 40s or 50s or even the 90s like it was in March of 2020. I can't completely explain the whole thing, but I'll attempt to give you an answer to that in a minute. But those B's on there are the other system we trade, the spike peak buy signal. So the red letters are successful, red and orange are successful signals. The blue ones are not. You can see it's struggled here since August, where a couple of times volatility spiked up and come back down, but it hasn't really generated much of a rally in the stock market. So we're still trading this system. It has a long history. We've traded it for years. It's generated a lot of profits for us, just not the last 3 trades. So one of these is setting up right now, though. We're in a spiking mode in VIX. And today, let's see, I think I wrote the number down here. Yeah, today, if VIX closes below 31.53, we'll be getting a new spike peak buy signal. So right now, as we're speaking, VIX is 32.36, so still above that. So this big rally that we're having today, VIX is only down $1.20. So essentially, VIX traders are not buying the rally. That's what not buying into the concept of the rally is what I mean. So we'll see, but that's the number right there. And if VIX goes to higher levels than this, then that number would change. But we keep these numbers up to date in all of our daily publications. Now, the other thing is, I mentioned the trend of VIX. And so the trend is defined by having both VIX and its 20-day moving average on the same side of the 200-day moving average. Right now, they're both above. That's bearish for stocks since VIX is trending higher. So uptrend in VIX is bearish for stocks. Downtrend in VIX would be bullish for stocks. Just one other little point about VIX. Last year, it really never fell below 15, even though S&P recovered from the pandemic and was making new highs all the time. And then this year, it really hasn't gone below 19. So what determines the price of VIX is the price of SPX options. Those are expensive options. That's really the realm of big money. And big money isn't always smart money, but it is a lot of the time. And big money is keeping VIX elevated because big money is still worried about the market. It's just roughly that simple. So the last thing I want to talk about with regard to VIX is which can you really trade, because you can't trade VIX itself, but you can trade futures and options on it. So in a bullish period, if we look at the pricing of the futures, they slope upwards. The near-term futures here, the next month here, et cetera, et cetera. And typically VIX itself would be below these levels. In a bear market, just the opposite happens. This was quite distinct in March of 2020, but the near-term futures would be the highest price, then second, spread on down like that. That's bearish. So where are we right now? I grabbed these prices just a couple hours ago around noon, and VIX was 31.92 at the time. You can see that the October futures are trading at a slight discount. 31.10 is where the October futures are trading. Subtract the price of VIX, we get minus 82. Not only that, you can see October is higher than November, and November is higher than December. Then after that, it gets kind of funky sideways. No real trend to the term structure. So this is a little bit negative. The front end sloping downwards like that. Remember this picture, that's bearish, but it was only the first 3 months. These things all being at a discount, that's not helpful either. So again, I would rate this as modestly bearish in its outlook for stocks, but not crazy bearish. I mean, in 2020, the discounts got to be 18 points and stuff like that. The CBOE publishes 5 volatility indices, and we can look at them too if you don't actually want to look at the CBOE. VIX futures as actually the CBE, Chicago Board Futures Exchange. Anyway, the CBOE publishes, of course, VIX, which is a 30-day index, but there's also a 9-day, a 3-month, a 6-month, and a 1-year. Again, in a bull market, these will all be sloping upwards in price, but you can see this goes up, then down, then up, then sideways. So it's kind of mixed. And mixed is not bullish. So you might say it's just neutral and maybe a little bit bearish. But one thing that's worth noting on this chart, you can see that at the time I took this, and it's still the case right now as we're speaking, VIX is higher than the 3-month. And so that's a negative condition, a oversold condition really, but it's a negative term structure. And when that reverses, we get what we call the VIX crossover buy signal. So right now, this condition exists, the first condition. And we're waiting to see if this will happen. When VIX finally does close back below the 3-month, then that is a buy signal for a short-term trade. So that's setting up, but hasn't been completed as a signal. And again, as I said, we don't trade oversold conditions. We only trade actual signals. So the conclusion here is that the term structure, well, I call it a construct because that's the term structure, the premium, the discount, all that stuff thrown together, is modestly bearish. This has been a big bear market. We're down 27% from the highs, and still this whole concept of VIX has not been nearly as negative now as it was in prior years. So I mentioned earlier, what's going on with VIX? Why is it lagging like this? Well, first of all, there's a sort of a theory that people kind of already own the puts they want to own, and they're not really aggressively buying more because the market's not crashing; it's just going down at a steady pace. Also, a lot of protection strategies now involve buying put spreads. So you're buying one put, you're selling another. That's not really putting any upward pressure on the price of puts necessarily. On the other hand, there's a lot of big traders, aggressive traders, who are willing to stand the risk of selling out deeply out of the money S&P puts because they're, well, overpriced. And so you've got this little bit of excessive supply. The demand is not so great, and VIX is just lagging. It's not going to 50 like it did in almost every correction we've had since, I can't even remember when. The only time it really didn't was that December 2018. Anyway, just to summarize, so what do we have? We have one bullish indicator right now. That's the McMillan volatility band buy signal. We have two neutral signals that could become buy signals, the spike peak and the VIX crossover, which we just talked about. Everything else is bearish. The chart of S&P downtrend, the chart of VIX uptrend, which is bearish for stocks. Equity put call ratio still going higher. New highs versus new lows. You can't even get new highs into double digits. Breadth oscillators extremely oversold, and this construct that we just looked at. So yes, some of these things could roll over to buy signals, but they haven't, and until they do, we're not moving them out of that column. So the weight of the evidence there certainly supports holding a core bearish position, and we'll trade these other signals around it as they occur. All right, so let me just finish up by talking a little bit about an offer we want to make to you. This website, and optionstrategist/MCM web, you can go there and download the PDF of this webinar. In addition, and there will also eventually be a link to the recording. In addition, there's a great price here on our home study course, 14 webinars really for $199. Or if you prefer just to jump right in and start trading, our 3 best newsletters, 1 month of each, $99 total. And you don't have to take them all at once. You can take them consecutively, not concurrently. So you can take 1 month of daily volume alerts, then switch over to daily strategist, and then option strategist. The option strategist comes out once a week. We've been publishing that for 31 years. The daily strategist comes out twice a day, and daily volume alerts comes out once a day. The daily volume alerts, I write that one myself along with Sage Douglas, and we have been pretty strong this year on the signals that I've just described in this newsletter. As we don't invest more than $1,500 and usually less than that in any one position. These systems have a good track record. They're up a lot since 2018, and the entire track record of that time period is available on our website. Also, now this says we'll send it to you. You have to download it. We have a YouTube channel. I record a market comment every Monday. I invite you to subscribe to that. And we have a couple of other newsletters too. Those who are interested in more conservative strategy, out of the money put writing, and then also special situation trading. So one final chart. This is the chart of the 1973-74 bear market. I traded this market. I really kind of cut my teeth on this market, and I saw exactly how a bear market works. And this one is just as close to that one as any I've ever seen. Maybe 2001, 2002, that bear market, but this one is very close. So we made an all-time high in January, and we started down with these bouncy, oversold rallies. Even that big one there, and then came down, kind of went sideways for a while. At that time, the three I's, inflation, interest rates, and impeachment, were worrying the market. Nixon was, in trouble with Watergate, and then Nixon resigned. The market went into free fall. Finally, made a new low. Gerald Ford came out with his Whip Inflation Now campaign, which was, he didn't whip inflation, but it did halt the decline in the market. I can't explain it. Market rallied back, made a classic W bottom, and that was really the end of the bear market. But it was, almost a 2-year bear market, 3 months shy of that, or even 1 month shy if you want to count the retest. So where do I think we are right now? I think we're right there. So we're due for a big rally, a rally that really hurts the bears. Bear markets, there's an old saying, no one makes money in bear markets because the bulls never give up on their old philosophies and they just hold all the way down. And the bears get killed by the rally. So we'll see. I think our short-term trading would avoid a lot of the pain, but we are so oversold that there's a possibility that we could launch a decent rally. And as it unfolds, our indicators will definitely roll over and be buy signals as well. So that's my contact information. And if you're interested in our money management, there's a separate website there at the bottom of the page. But Rob, let me shoot it back to you.
My mute button wanted to give me a delay. Thank you so much, Larry. As usual, incredibly informative information. Ladies and gentlemen, this is Mr. Lawrence McMillan of the McMillan Analysis Group, and around here we call him the E.F. Hutton of options traders on Traders Corner, because when Mr. McMillan is talking options, it's a real good idea to listen. Keep up the great work, Larry. It's always a pleasure having you. I was waiting all day to listen to your perspective on the current market environment. We hope to see you come back to see us soon here on Traders Corner.
All right. Thanks for having me.
No, hey, thank you for being here. Ladies and gentlemen, you can find Larry at www.optionstrategist.com to learn more.